Hello and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we are very pleased you have joined us for our Financial Services Conference. Our next presentation of the day is from QNB Bank. Please note, you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for a one-on-one meeting by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome Dave Freeman, President and Chief Executive Officer, and Jeff Lehocky, Chief Financial Officer of QNB Bank, which trades on the OTCQX Best Market under the symbol QNBC. Welcome back, Dave and Jeff.
Thank you. We appreciate that. And thanks everyone who joined us today. It's been an eventful week, which we're going to talk about later on as we go through our presentation. We look forward to viewing a little bit about our bank and then hearing any questions and responding to any questions you may have. And as Greg mentioned, we're certainly willing to meet with anyone that wants to talk to us after the fact also. We'll start off with our first slide here, just talk a little bit about our history in the community. We've been around almost 150 years now. We're in a really dynamic market. Meds and eds, big industries in the Lehigh Valley and the greater Philadelphia area. We are in two of the collar counties around Philadelphia, Bucks and Montgomery counties. We also have branches in Lehigh County, and we do a lot of business in those three counties plus Northampton County, then also in the greater Philadelphia area. We have seen some nice, this year we've done well in the core funding, and what's been nice is that we started to see an increase in our non-interest-bearing demand deposits, which is the first time in a while since the rates went up. So that's encouraging and hope to see that continue. We do expect that to continue. So talking a little bit about who we are and our vision and mission, and we talk a lot about our bank, about these four constituencies, and really trying to serve the interest of all four of those groups. And we think that allows us to grow and allows us to continue just to be an independent bank, which is our goal. A little more detail on the strategic plan. Big issues for us are we're constantly having to invest in technology. When we talk about the merger, one of the things that we want to get larger is to spread those costs over a larger organization. And we also see an opportunity with applying AI to improve processes, and so that's going to be something that's going to get a lot of our attention over the next couple of years. Employee retention is crucial. We have a lot of long-term employees, and that's really a lot of what we're all about. We have an exceptional customer experience, and we should be rolling out a customer referral program, which would encourage them to refer new customers to us. So we're looking forward to that. Check losses have been an ongoing issue. We did take a lot of steps to de-risk us on that side, including positive pay for a lot of our at-risk customers, but it continues to be an ongoing battle. So we are constantly fighting that and looking at tools and trying to stay ahead of the curve on those. Our bank management team, we have a really tremendous team, a lot of different experience, both here and at other organizations, and I think that's important. And we do have some folks in our organization when we talk about the merger, and Chris Caddy and a couple of other high-level managers that have had experience in the M&A, which will be helpful going forward. Talking about our core markets. We have branches, as we mentioned, in those counties, the 12 branches, but all of our locations, we have a very large, compared to our peer group, large deposit size per branch. So we tend to have larger branches. We think that's beneficial, and we definitely try to encourage household growth in everywhere that we are, and that's an important metric for us. And this is just as an overview of where our branches are located. We're kind of, if you're from the Philadelphia area, you kind of think about this as mostly the 309 corridor, and that's really where our branches are located at this point in time. Big announcement this week, obviously. We announced the first acquisition in our history. Victory Bank Corp is headquartered over in Limerick. Some highlights there, but I think what we really looked at there is we've been in discussions with them for 6 months. They have a similar culture to us. They're as similar in how they're approached to business. They're primarily a business lender, which is the same thing that we are. We see the opportunity to acquire assets to get into new markets in Limerick and in Horsham and Wyomissing, and also have the opportunity to acquire talent. That's a big thing, particularly on the lending side, to find people that are experienced and that will fit into our culture. So looking forward to, I'm sure we have some questions about that, and we are definitely excited about that acquisition. And now I'm going to turn it over to Jeff to go through the rest of the slide presentation.
Thanks, Dave. It's an exciting time in QNB's history. The announcement you see here was made on Tuesday. It was only 148 years in the making, so we're pretty proud and we're pretty excited on the way forward. So it's a pleasure to be here today. I know that everyone has a PDF of the slides, and there's a lot of data here, so I'm just going to touch on some of the key points. I'm not going to do a deep dive in any detail. I want to leave plenty of questions for the end so that we can answer your questions. So, in terms of financial overview, I think the summary is the overall theme is growth fueled by business with our core customer base. Year-on-year assets have grown by 7%, mainly driven by new loan origination. It's important to note that that has followed an 11% increase in loan balances in 2024. So we're really seeing strong momentum. As our loan portfolio has grown, credit quality has not been compromised. The modest increase you see in non-performing assets was due to one relationship where we are well collateralized and we don't expect a loss. Loan growth, together with the repricing of our existing loan balances and a reduction in our cost of funds, has led to record net interest income. And this has driven a 20% increase in earnings and an improvement in our ratios. One editorial note on this page, the year-to-date efficiency ratios shown on the right side of the page are actually been reversed in error. As you would expect with improved performance, our efficiency ratio is actually going down year on year, not going up. Looking further into earnings, net interest income shown on the top right of the page in the blue bars has been steadily increasing the past 2 quarters. And I'll note that there was a significant jump in the second quarter of 2025. I'll drill down later in the presentation. However, we expect net interest income will continue to drive our performance over the balance of the year. Also on the top right side of the page, you can see movement in credit provisions each quarter represented in orange. Overall, our credit quality remains strong with a very low level of specific provisions and write-offs. The movement you see in provisions each quarter is more driven by qualitative macroeconomic factors that are built into our CECL model. It's not related to the quality of any individual specific credit. I'll speak more on expenses later, but I'll note here that expenses as a percentage of assets has and continues to remain at a very consistent level, and our core non-interest income has been stable. Turning to the balance sheet, as I mentioned earlier, we've had significant growth in our loan balances through the end of 2024. However, in the first half of 2025, net loan balances have been flat. While new loan growth has been excellent, overall net loan balances are flat due to the payoff of existing loans resulting from business sales and interest rate resets where customers are opting to pay off the loans rather than pay a higher interest rate. However, the net effect of adding new loans at current market rates and the payoff of existing loans at lower rates is having a positive impact to growth in our net interest income and in our net interest margin. Also, our loan pipeline is at a high level, positioning us well for continued growth in the future. Meanwhile, deposit growth has been strong over the past few years and has continued thus far in 2025, driven by core customer balances. And the cost of deposits is steadily coming down, which I'll cover more in depth later. The last point I'd like to highlight on this page is the increase in regulatory capital in 2024. This was driven by the issuance of $40 million of subordinated debt, which has positioned us well to support continued asset growth. Continuing with capital, all regulatory ratios are significantly above well-capitalized levels. As mentioned on the last slide, capital has been solidified by the issuance of sub-debt. At a consolidated level, our total risk-based ratio has increased from 13% to 15.8%, and the sub-debt has been pushed down to the bank, resulting in a significant improvement in our bank capital ratios and our legal lending limits, enabling continued asset growth. Taking a holistic look at loans, balance have roughly doubled over the past 10 years. However, half of that growth has occurred in just the last 3 years, and our pipeline of new loans is at an extremely high level. Asset quality is strong. Non-performing assets and net charge-offs are low, and we compare favorably to our peer group. As mentioned earlier, the modest increase in non-performing assets was due to one commercial relationship where we're well collateralized and we don't expect a loss. A breakdown of our loan portfolio shows it is well diversified. More than half of the portfolio has a loan-to-value of less than 60%, and roughly 3/4 of the portfolio has a loan-to-value below 75%. The effective duration of our loan portfolio is generally short, with mortgages less than 6 years and commercial real estate at roughly 2 years. The portfolio is well structured with strong collateral, and we have no exposure to inner-city office commercial real estate. Also, the yield on the portfolio continues to increase as new loans are added and existing loans reprice at current market rates. Turning to our investment portfolio, the yield on the portfolio has increased 130 basis points over the past 2 years. In parallel, the effective duration has been reduced by 1.2 years. This is due to the diversification of the portfolio into floating rate securities and into bank sub-debt, all of which is investment grade rated. Also, portfolio metrics have improved due to the addition of pay-fixed swaps in 2023. With respect to our deposits, our portfolio is well diversified with low concentration. It's important to note that disintermediation out of non-interest-bearing deposits leveled off in 2024, and that has continued in 2025, as Dave had referred to earlier. As a result, non-interest-bearing deposit balances have been stable for an extended period of time. Also worth noting, unsecured deposits are low, with only 18% of deposits either uninsured or non-collateralized. We are pleased to say that our core customer deposits have consistently accounted for roughly 97% of the portfolio, a level that is higher than the average of our Pennsylvania bank peers, where they've seen their ratios falling over the past 3 years. Also, the cost of interest-bearing liabilities continues to come down and is lower than peers, an advantage that has been expanding over the past 2 years. This chart compares changes in our deposit costs versus changes in federal fund rates. In the current interest rate cycle, our cost of interest-bearing deposits has increased at roughly half the rate of the increase in Fed funds. This has resulted in a 191 basis point funding advantage, which is higher than the funding advantage in the prior rate cycle. This chart further illustrates the continued improvement in our net interest income and in our net interest margin. The rate received on assets minus the rate paid on deposits stabilized in 2023, and the spread has been steadily increasing since the middle of 2024 and is now larger than it was 2.5 years ago. As mentioned earlier, this is due to new loan growth and rate resets on existing loans, as well as the cost of deposits coming down over the last 3 quarters. Based on our asset and liability profile, we feel good about how we are managing our interest rate risk. Overall, our profile is well balanced across rates up and rates down scenarios with a slight asset sensitivity. A few observations on efficiency and net interest margin. Expenses as a percentage of assets continues to be stable. Growth in assets has enabled us to make necessary investments in our infrastructure to better serve our customers' needs. Although net interest margin showed a slight decrease in the fourth quarter of 2024 when we issued sub-debt, our margin has risen 31 basis points over the last 2 quarters. Net interest margin is now at a higher level versus 2.5 years ago and is expected to further rise over the rest of the year. Let's wrap up with a look at our stock performance. As was the case with other banks, QNBC's equity traded lower as interest rates rose in 2022 and 2023. However, as our financial performance improved in 24 and in 25, QNBC equity has traded significantly higher. Movement in our share price has fared well relative to our banking peers, as you can see here on this chart, with QNBC represented in orange. Our equity valuation has increased by more than 50% over the past year or so. And finally, we'll end with a few words on our trading liquidity. We are committed to increasing our shareholders' ability to trade in a highly liquid market. With the acquisition of Victory, we are taking a hard look at an uplisting to the NASDAQ, which would provide much greater liquidity to our shares being traded. We expect to come to a decision over the next few months, so stay tuned. That brings us to the end of our presentation. Dave, back over to you for questions.
Great. Let's see. The first question we have addressed is what differentiates QNBC's approach to community banking relationship building, particularly given your strong loyalty metrics. Really, we feel that a lot of that is related to employee retention and consistency also in our approach to customers. So we really make an effort on both the retail and the business side of really looking at the customer's interests, serving as their advisor, as a trusted advisor, and we keep our lenders here for a long time. So our business customers aren't constantly going out and having to tell their story over and over and over again. So basically, we build the loyalty, we grow with our customers, we acquire new customers, and then we keep them for a long time too. So that's really been the key. And I think we do that as well or better than anybody in our marketplace. Let's see. How is QNBC leveraging technology and product innovation to maintain or increase its competitive edge among peer banks in your region? Our goal in technology is to be a fast follower, not to be on the cutting edge. And we do believe we've been able to do that. When we see a trend, with stablecoin and crypto starting to be a trend, we pay attention to that. We figure out what's the best way in terms of us serving our customers to use that technology. We also are constantly looking at technology and improve our internal processes. And every time our chief information officer or their chief operating officer talks about our IT initiatives, it's remarkable how many things we get accomplished on an ongoing basis. But that's important for us, and we have to stay relevant to our customers when it comes to technology. Let's see. How does management balance the goals of steady, responsible growth versus pursuing transformational opportunities, such as the recent merger that may present higher risk or integration complexity? I'd say, we definitely feel like we can grow on our own without having to acquire another bank, and we have demonstrated that. The challenge is that to grow at the level we need to grow to incur the additional cost of technology and talent and all the other things that are related to running a bank. It's challenging unless there's market disruption for us to go at the rate to do that. And we feel the acquisitions give us an opportunity to grow more quickly. We definitely felt like a situation with Victory where we had a negotiated agreement where we're trying to look out for the best interests of both groups of shareholders. We're also trying to look out for the interests of their employees. We have a similar culture. We know we can take care of their customers, so there won't be that transition. We think those kinds of opportunities, especially their size is about a quarter of our size, we feel like the risks there are low enough that it makes sense to move forward, and that's why we did. Let's see. Do we have target ROE and ROE post-merger with Victory Bank you can share? Jeff, I'll let you answer that, which we can, I don't believe.
You give me the no comment question. So
That's right.
We've not put together and published a investor presentation with performance metrics, targets, forecasts for the merger. So at this point in time, we're unable to provide any further color. As we get through our filings, we will certainly be sharing more details with you in the near future.
Here's a question you're actually be able to answer, Jeff. With regulatory capital well above required levels, what is your capital allocation strategy for the next 12 to 24 months? Is there potential for increased dividends, share buybacks, or additional M&A activity?
Well, we just announced a pretty significant use of capital with the acquisition of Victory, right, which should close sometime early next year. So that's our big initial play in terms of capital use. However, we're always evaluating what's the optimal level of capital and how we utilize it. So all options are on the table. It's just a matter of opportunity and execution. It's important for us now to complete the Victory acquisition, make it a success before we turn our attention to other potential M&A activity. However, as we're doing that, we're certainly going to be evaluating in parallel our dividends, our strategy and philosophy on share buybacks. So there'll be more to come on that in the future.
There's a question, do we see any opportunities in Chester County? I say, yes, we do. We have done some lending in Chester County. I know we have a residential subdivision that we're financing now at QNB. Victory has done a lot more lending in Chester County, so we're going to evaluate what additional opportunities there are there. We also are going to look at our Community Reinvestment Act area as a result of the merger, and there will be some changes to that too. Let's see. Oops, go down the list a little bit. Well, with the acquisition of Victory Bank Corp and the resulting $2.4 billion in assets changed QNBC's growth trajectory and position in the Pennsylvania banking market. Obviously, it gives us a leap forward. At our current growth rate, would probably be 5 years away from being at that asset level. So it allows us to be there more quickly. Again, gets us into some markets we haven't been. We looked at those 3 markets. Limerick, we have very little presence there, very little lending in that greater market. Wyomissing, we have, again, next to no presence there. That's a very nice suburb of Reading. We think there's tremendous opportunities there to pursue the lending and possibly a deposit office there in the future. And then Horsham, is similar to our Warminster market in that there's a target-rich environment, as we call on the business side. There's 1 million office parks and many opportunities to do business lending in that greater area, and not a lot of community bank competition. It's interesting because we've done a decent amount of lending in Lehigh Valley, but the Lehigh Valley has seen the presence of many of the banks from north of here, Square and Wilkes-Barre area particularly, establishing a presence there. And so from a competition perspective, it's actually been more competitive in the Lehigh Valley than it has been in Bucks and Montgomery counties, and we expect that to continue for the near future. Let's see. We talked about, there's a question about loan growth. It's always difficult to predict because you don't know what's going to come and go. But as Jeff mentioned, we have the largest pipeline right now in our history, and so we feel pretty good about where we stand on that. This is a good question, Jeff. How much is your interest rate cap added to your recent quarterly earnings? That's around our swap.
Okay. Sorry, I was searching for the mute button here. We entered into the swaps. I guess it was a little over 2 years ago. It was a pretty opportunistic timing. It's good if you're smart, but it also helps if you have some good fortune behind you. So at the time we entered into the swaps, we had about 175 basis point advantage on 300 million of swaps. So we've been receiving net interest from PNC for the past 2+ years. With the latest Federal Reserve cut of 25 basis points, we're still about 50 basis points to the black. So still profitable in that sense. But if you take into account what we've earned over, I don't know, I guess it's the 30 months or so that we've had the swaps on our books, we've fared quite well as a result.
It was a tremendous lift at the time with the challenges we all faced. And I think when we first started that swap, we were generating $400,000 a month in income pre-tax. So that was really important for us during those difficult times and helped us get through that. We had a question about the integration risk exists with the acquisition, successful post-merger transition. We would view that as being, basically keeping the customer base, making sure those folks stay with us, and equally important and consistent with that is keeping key employees of Victory Bank, particularly the customer-facing staff, and then key operations people that can help us moving forward. So those are the 2 big risks, and we're going to do everything possible to be on top of that and start that process as quickly as possible. I think we're pretty close to the end of our time. If anyone else again would like to reach out to us separate from this, please feel free to reach out to Jeff or I at any time. I believe our contact information is out there, and we're happy to talk with anyone who would like to talk to us about our organization.